I've turned my portfolio from $0 4 years ago into over $700,000 trading stock options. I'm gonna go through crystal clear examples about calls, puts, selling puts, buying puts, and all the risks associated with all that so that you can be a better option trader, because I made a lot of mistakes in the past. So heading over to my portfolio, I do all my trading through Charles Schwab. As you can see, 2 years ago, I had $258,000. Heading over to the right hand side, I'm over $700,000 right now. So far in 2024, I've racked up $115,000 in profits with my options trading. My goal is to end the year at over $200,000, and I want to have my portfolio over $1 million. So I have a step-by-step plan that I follow that I'm going to help you guys follow so that you can have similar returns to what I have. You don't need to have a bunch of money in your account to do what I'm doing. You could start with an account with $1,000 in it. So starting from the top, what are options? How do you trade them, and how does it work? So the first thing that you need to understand is every one option contract is the right, but not the obligation, to buy 100 shares at a certain price in a certain time frame. And then going a little bit deeper into that, we have two things to worry about. We have a strike price and an expiration date. So the strike price is the agreed upon price that you'll either buy shares for that price or you'll sell shares for that price. And then the expiration date means the contract is only valid for that time frame. What if I think that the stock is going to go up, or what if I think the stock is going to go down? How do I use options to make money on this? So if you think that a stock is going to go up, you would buy call options. If you think a stock is going to go down, you would buy put options. So when you buy a call option, you are buying the right, but not the obligation to buy a certain amount of shares in a certain amount of time. So for example, let's say that you buy one contract of Triple Q. Okay, you're bullish on the stock, you think it's going to go up, and you say, I want to be able to buy 100 shares of Triple Q anytime between right now and 5/5 of 2025. So you buy this contract and you have a strike price of $500. If the share price of Triple Q goes up to $550, you're able to buy those shares for $500. So you're making a profit of $50 a share. But remember, if you buy one contract, you're able to buy 100 shares, because every one contract equals 100 shares no matter what. So if you have 100 shares and you made $50 a share, you just made $5,000 on that contract. So your next question is going to be, how do I actually buy this call contract? So what you do is you go to your broker, you type in the symbol Triple Q, we're going to do a call, we're going to buy the call to open, and we're going to do one contract. So if we want to buy Triple Q, let's go out to 6/20 of 2025, for example, and we want to do a $500 strike price. So if we want to do one contract for a strike price of $500, we're going to have to pay $2,617 to have that contract. Now let's say that we're bearish on Triple Q. So what you could do is, instead of buying a call, you could go up here and you could buy a put. So a thing that's very common for people to do is, let's just say that I own 100 shares of Triple Q, but we're going to come into an election cycle in November. So if I'm scared that maybe the market's going to go down through the election, I could go out and buy put options. So what that means is, for example, right now the price is $457. If I buy a put option with a strike price of $450, I am guaranteeing that I could sell those shares for $450 a share no matter what. So if the shares happen to fall to $400 a share, I could still sell those for $450 a share, because that's the contract that I bought. Now, to have the right to sell those shares for $450 anytime between now and June 20th of next year, I have to pay a premium of $2,600. So that's how that works. If you're bullish, you buy calls. If you're bearish, you buy puts. So now we're gonna go a little bit deeper into how I generate over $20,000 a month on average. So in order to buy something, somebody has to sell that to you. So going back over here, if we wanted to buy this put on Triple Q, we have to pay $2,600, but you're paying that to someone else. So what I like to do is I like to be on the other side of the trade if I'm bullish. So if I think the Triple Q is gonna be at $550 a share a year from now, I will sell these puts to someone else, because they're gonna pay me $2,600 to have that right. So my bet is that if the shares either go up, stay flat, or don't go below $450, I'm gonna collect this premium and the contract will end up being worthless. So to say that in another way, they are paying me $2,600 and I'm guaranteeing that their share price that they can sell them for is $450. So like I just said, if I'm bullish and I think it's either gonna go up, stay flat, or not go below 450, I'm in the clear. So my goal when I sell these contracts is I just collect these premiums, because most of the time these contracts will expire worthless. So here's the flip side. Let's say the triple Q happens to fall to $440 a share. So what's going to happen is I am forced to buy his shares for $450, even though they're currently worth $440. I'm overpaying by $10 per share in that situation. So this is where I'm going to come into my next point. You only want to sell puts on stocks that you are okay to own for the long haul. So let's say that the current price of triple Q is $450. You were supposed to pay $460 for them. You're technically down $10 a share. If you believe in triple Q for the long run, maybe you're overpaying by $10 a share right now, but maybe if you hold on to those for another year from now, they'll be at $500 a share. So you overpaid $10, but that's okay, because then you could sell them for $500 a share and then you'll be up $40. Historically speaking though, if you hold on to triple Q for 1 year, you have an 80% chance that you made money. We don't necessarily need triple Q to go straight up in order to make money on this trade. So here's an example of a trade that I actually do and kind of the parameters that I would set. So if triple Q right now is $450 a share and I sell the put at a $400 strike price, so I have a $50 buffer, that means the triple Q can go up, stay flat, or go down no more than $50 per share. The chance that that is going to play out to where the contract is worth nothing, meaning it's worth nothing as long as it stays above $400 a share, is pretty likely, honestly. There have been a couple of times where I did get assigned the shares, but it didn't really matter. So I was assigned the shares because I had a strike price of $400, and the current price of triple Q when I got assigned was $399. Then the next day triple Q went up to like $405, and then I just sold them and made money on them anyways. So that's why you have to do this on something that you are okay to hold for the long haul. So heading over to my portfolio, this is everything that I have open in this account. So as you know from my other videos, I'm super bullish on the Russell for the next few months. So I bought some 220 calls, which I'm already at $5,000 on. I sold some 215 puts, which I'm down $1,000 on, but that's okay. I'm gonna give that one time to play out. And then going through the core of my puts, over here, these are my strikes: 350, 345, 400, 400, 350. And I mean, look at these unrealized gains: 8,000, 5,000, 5,000, 6,000, 14,000. I mean, I've been doing pretty good, but as of lately, I haven't really been selling a lot of put options because it seems like the market is going straight up. So the main reason why I don't usually like to sell puts when the market is going straight up is because this red line right here, it corresponds to the earnings growth of the companies within the triple Q. So when the market took this dip right here in 2018 for COVID, I knew that these companies were still going to be okay. So I was selling puts like crazy because I was expecting a big bounce to happen. Now, if you continue this line all the way through, right now we appear to be a little bit overvalued. I'm a little bit more hesitant to sell puts when we're overvalued because it's more likely for that stock to come back down, and that's called reversion to the mean. So when things are high, I'm not super excited about selling puts. I would maybe consider selling call options, but I don't really like selling call options because your risk is technically unlimited. So let's just assume that you sold some puts and then the market starts to go down. Let's say you sold a $400 strike price and the current market price is $390. What do you do? So what's going to happen is on expiration day, sometime after the market closes, you will be forced to buy all those shares. So if you sell one contract, you're going to have 100 shares sent to your account for $400 a share. On your gain loss page, you're going to be down $10 a share because the current market price is $390 on them. So you paid $400 for something that's only worth $390. At this point, I would be on margin. So I would take all those shares, I would get credited the 100 shares, but then if it's $400 a share times 100 shares, I'm going to be on margin for $40,000. So now, what do? Do I sit on the shares on the margin, or is there a way that I could try to make money on these shares while I have them? So what you would flip and do is it's called the wheel strategy. So in the wheel strategy, you would sell calls on those shares. If you have 100 shares that you're okay to sell you will sell call options for say a $400 strike price and they're currently at $390. Maybe you do 1 week call options, okay? So stay with me. So if you sell 1 week call options with a strike price of $400 and the current price is $390, you might be able to collect $500 a week selling these call options. So the interest that you're accruing while you're on margin is being totally wiped out because you're making these consistent profits on your call options that you're selling. Now let's say the triple Q happens to pump up and you're forced to sell those shares, because when you buy a call option, you're buying shares at a certain price. And when you sell the call option, you are gonna sell your shares at a certain price. So you will sell your shares at $400 a share, and then you're no longer on margin. So you made the premium off the rip when you sold the puts, you're making the premium while you're sitting on the calls, and you just essentially sold the shares for what you bought them for. You were forced to buy them for $400 a share, and then you sold them for $400, but you made the put premiums and the call premiums. So that's called the wheel strategy. And if I ever do get assigned the shares, that's what I will do. But usually I don't get assigned. Now there's gonna be a ton of people blowing up the comments saying, you've never been through a recession, you've never been through a bear market. Okay, I have been through recessions, I have been through bear markets, I've been through 2008, I've been through COVID, I've been through times where the market has turned down rapidly 20, 30, 40%. So in times like that, we probably will lose a little bit of money in the short term with options. But when you hold the shares for the long haul and you continue to sell those calls for maybe a year, you have to sell the calls for until you could sell them for what you were assigned them at, then you make money. But 95% of the time, you probably won't get assigned the shares. The reason why you probably won't get assigned the shares is because we're selling 1 year put contracts where, historically speaking, the market either goes up, stays flat, or doesn't go below your strike price. But since we're doing that buffer when we sell the puts, meaning the strike price is $400, but the current price is $450, what is the chance that the market's gonna fall $50 a share a year from now? It's possible, but it's unlikely. So those are the bets that I am playing right there. Now, keep in mind, this doesn't work all the time. Like I said, I am not selling puts right now because we're going into an election year and the stock market's been going straight up lately. So I wanna let things cool down. I'm okay if stocks come down a little bit because, number one, all my strike prices that I showed you in my portfolio are way below the money because I sold a ton of puts when the market was down and then it ran up. Now, if the market takes a dip going into election, I'm gonna be selling puts like crazy. And then when the market goes back up and recovers, all those contracts are most likely gonna expire out of the money. If 10 is full bull and 0 is full bear, I'm kind of at like a 6.5 right now. So I'm not super bullish, but I'm not super bearish. I'm kind of in the middle-ish. So I'm kind of just letting things fizzle out. So if you made it this far, like, subscribe.